Hello and welcome to this August edition of Newswire. Obviously the summer is normally a fairly quiet period, but we've had some contention. So one or two of the issues that will arise from the revenue are probably the most contentious that I've seen in the last 20 years. So I'll leave that till last just to give you that bit of suspense to this little bulletin. The first thing, if you're reading Newswire, you will see is a bit of guidance issued by the Revenue on non-residential property transactions. This is the capital gains element of this. So for residential property transactions, etc., for non-residents, clearly the practicalities of making the reports, how do you amend a report, and so on and so forth, interaction with self-assessment system. All of those things have been questioned a little bit with the Revenue for people particularly dragged into this regime for the first time, and consequently the Revenue have issued a bit of guidance. So you'll see the link in there, and if that's a particular issue to you, then you can obviously go away and have a look at the guidance. I suppose the one thing to note, that sort of issue plus a lot of others will be covered in our autumn tax update courses. And amazingly, we are back in face-to-face venues in a lot of the country. So my first session, interestingly, is in a week or so's time in Plymouth. Now, bearing in mind I live in Derby, I can't tell you how happy I am to be driving to Plymouth for the first time. So hopefully I will see some of you on those autumn tax update courses and also on the face-to-face. If that's your preference, then feel free to join us. The second little item in Newswire you'll see reference to is naming and shaming of more employers for minimum wage purposes. And I think very much the process over the last couple of years has been the Revenue getting much more interested in minimum wage compliance. We've had a lot of statements, all sorts of things, tweaks in law coming into this particular tax year. Obviously, quite an important mechanical change that the government have said that the living wage rate, the highest rate, is payable to 23-year-olds upwards rather than 25-year-olds as it has been. So I think the basic model of minimum wage is getting a lot more attention from the Revenue, as shown by the naming and shaming. Penalties are back in play. The law has changed a bit. We've had case law developments over the last year relating to things like care and residential workers. So we've got a lot of movement in minimum wage. And I think the thing to bear in mind is if you've got clients who are paying down at the bottom of the income scale, there are lots and lots of reasons why minimum wage may be wrong. It's complicated, but they basically need an awareness that the take-home pay before tax is broadly equivalent to minimum wage. That's what they need to understand after most deductions, etc., etc. So minimum wage, a bit of a continuing thing with the Revenue. I'm sure we're going to see more. Keep an eye on that if you've got clients paying in those particular income brackets. And again, if you'd like an update on this and some other things, then join us for some face-to-face autumn tax updates. We can have a coffee and discuss the naming and shaming and who it was. So keep an eye on minimum wage at the moment. The third bit of news that I picked up over August was, again, some guidance from the Revenue on off-payrolling, some comments and so forth. Really in its early days, I suppose the biggest question that I've had over the last couple of months is now from the recipient's perspective. So if you're dealing with service companies that are now suffering off-payrolling, and I use off-payrolling wisely as opposed to IR35, bit of a different thing. But if they're now within the off-payrolling rules, one of the critical things about off-payrolling is matching the income to the money that is drawn by the client and the mechanics of how they draw it. That takes a little bit of explaining if you've not thought about it, if you've not seen it before. But very much as income becomes caught by off-payrolling, there is very much of a matching process to say, potentially the money that has been caught can be drawn tax-free. It's tax-free with no further tax. Obviously, it's already been taxed, so it's not tax-free, said the tax expert, but there you go. But certainly there's a matching process to make sure that you are not suffering any further taxation. One of the interesting questions I had recently was, what is the interaction between off-payrolling and the historic reserves which have been built up within that company? So, there's quite a lot to think about if you've got clients getting dragged within off-payrolling. If you'd like some help with that, obviously give me a ring. Alternatively, we have a recorded off-payrolling course from earlier this year. We will be doing another couple early in the next year, sort of a year on. So again, plenty of resource on our website to address off-payrolling if you are inclined. The fourth little snippet relates to COVID support measures. Obviously, we're drawing near the end of all of these support measures now. I think really what you've seen from the revenue over the last month or so is reacting to information that they are seeing, or in fact not seeing within returns, and trying to give guidance to people in relation to where it should go on the return, and trying to illustrate. It's interesting, one of the things they've said is you might have stuck it in the return, but you might not have stuck it in the right box. So please let us know if you haven't stuck it in the right box. So the mechanics we are starting to see. Last year's Finance Act contained a lot of compliance legislation for the revenue to go back and start looking at claims and recovering money if it's in error or overpayment or whatever. Personally, I've not seen any of that so far, but I'm sure we will do. In light of the fact as well, we know that the revenue have created a specialist team of over 1,200 people to look at COVID. So I think there's an interesting question for obviously people in practice. To what extent with any given client do you scrutinise the claims they made under furlough or self-employed income support or whatever it may be? There's a level of, well, the client did it, and therefore, unless it's glaringly obviously wrong, then what obligations do we have? The next stage on, though, I think if nothing else, the client needs to understand that they must be able to support, if asked, what they did for at least the next 6 years. And so as you see those clients coming into the sort of heavy tax return filing period, I think if nothing else, they need to understand, they need to keep that information and make sure it does back up what they did for the foreseeable future. The compliance is going to be really interesting. I expect to have, see a number of those over future years, but I've certainly not seen them quite yet. And again, if you've got any COVID questions, we've got a number of courses in our recorded library that deal with the COVID support measures and the taxation position of them. So feel free to access those as appropriate. The final part of Newswire that you'll see is a little blog that I've written to do with MTD. Now, you may understand that MTD is coming from sort of 23 onwards. And certainly the biggest sticking point in all of this, for me, has been, what is the point of it? Quarterly returns with real-time information, which the Revenue Act don't need to be necessarily accurate, but you've got to do them anyway. What is the point of that at all the time and cost involved in that? So I've been advocating direct action. Let's go and set fire to something and say this is a nonsense. But of course, we're British, so we moan and groan, and we kind of rumble on with the MTD project anyway. Revenue have released a document recently trying to say, lots of businesses like the electronic record keeping. Yeah, but that's not the same as quarterly submission of pointless information, you Berks. So anyway, there's a lot that goes on in this. Now, really, the Revenue have not helped themselves here by just dumping over the summer. Parliament basically dumped a consultation document and ran off. But consultation on reforming basis periods on the introduction of MTD. So basically saying basis periods will be tax years irrelevant of your accounting year, with everything that goes with that. Now, this is something the Revenue tried at the implementation of self-assessment 20 odd years ago, and eventually gave up because of the practicalities. And it's interesting, if you think of the vast majority of your self-employed clients are going to be filing 5 or 6 returns a year, 4 of them quarterly, and suddenly if you make their basis periods all the same, i.e. April, May, June, July, August and so on, then of course all of the quarterly returns have to go in at the same time. All of the tax comps need to be done at the same time, and so on and so forth. So there is a vast issue about practicalities here. And to be fair, the institutes for the first time for a long time have clubbed together and said basically, are you joking? But I think the more you can express your opinions through your institutes and say, are you joking? The answer is mass non-compliance. If the government insists on this, I think the accountancy profession has to say, oh, really, are you joking? We can't cope with this. Really interesting. I've given up on Revenue webinars pretty much now, but I watched one on MTD, and the people on there were basically asked about the additional costs. They said they couldn't comment because they didn't know, because they've never worked in practice. They were asked about software and said there's not much software out there you could trial at the moment because it's all behind the curve. And they just clearly do not understand the practicalities and the costs that go along with that. So a couple of options. There is an MTD course in September, another one in October, I believe. So we've got some online MTD courses if you want to catch up with the current position. Alternatively, join me on the barricades. Let's set fire to something. And if nothing else, knock the quarterly element and the basis period element on the head. So we will keep you up to date at this over the next few months. But obviously, pretty big issue. So take care and hopefully see some of you soon in real sense in a venue over a coffee, and we can discuss the strange times through which we have been living. Bye.
Thanks, Mark. And over to the A&A section of this bulletin. Well, it's been a fairly quiet summer for us in terms of A&A pronouncements, and a fairly quiet August as well, but there are one or two things to talk through. And let's start with audit reports. Now, many of you who follow audit report bulletins extensively are always excited to know that there's a new one or an update out, and time to get excited because there is an update, although it's not a major update. And for those of you who are using UK GAAP exclusively on your audits, then there's little to see here. The update is for minor Brexit related amendments to those of you adopting IFRS and the wording for that in the audit report. So it's not a huge deal to get excited about, actually. What a shame. Full details in Newswire, and you can follow the link from there, but not a great update. Let's stick with audit though, and one of the most exciting things to happen over the summer has happened this month. It is the release of the long-awaited exposure draft for the audits of less complex entities. Now, this is an international exposure draft from the IAASB, so it's not an FRC exposure draft yet. But this exposure draft sets out how a single standard for the audit of less complex entities could work. And it's an interesting read. It's short, although there are sections before and after the main event. The main meat of the standard is about 100 pages long, and that is short compared to the run of most ISAs, which exceed that in length. Lots of the requirements from ISAs are in there. It is very squarely an ISA-based audit approach. It's worth making clear, though, that you can't use it in conjunction with other ISAs. So, for example, if you had an entity which was less complex in all respects bar one, let's say there was one accounting estimate which was not simple at all, it was pretty complex, it would be tempting to say, well, let's apply the LCE audit standard when it's issued, and then for that one area, let's top up using bits of ISA 540. And you can't do that. You either apply the LCE standard as it is, or you apply the full ISA suite. So although it's very much based on ISAs, it is a standalone standard. That's how it's meant to work. It will disappoint some people, perhaps, that it isn't more cut down than it is, but there's just a lot less to read, and all the stuff that really is aimed at public interest entities has gone. There are some questions still remaining. One of the key issues, I think, is on the authority of the standard, who can apply it. And in particular, the draft standard excludes its use for the audit of group financial statements. Now, that will disappoint many people, and I think it has disappointed many people I've spoken to in the UK who feel that that's a missed opportunity. It's fair to say that the draft standard does include a fairly detailed discussion of that topic, and essentially says if we decided to include this back in, let's think about how that would work. Would that work on a strict threshold basis? So, for example, it could be applied to groups where there were no component auditors and the audit firm audited the entire group. Or would we do it on more principled basis? Essentially, if the group as a whole is less complex, then maybe that warrants its use. So I think there's enough possibility, at least, that group audit will come within scope, and that's useful. But like with all these things, it will excite some people, disappoint others, but it's just great to actually have a final exposure draft. We are some way off from that being produced into a final standard. Comments are due to the end of January 2022. And of course, it's uncertain as to whether or not the FRC will authorise its use in the UK in any event. They've been quite tight-lipped on that. But I think it's a step in the right direction, and by all means go and have a look at the exposure draft. You've guessed it, links are in the Newswire. So what other topics do we need to cover? Well, there are some proposed changes to IFRS. Let's get the dull one out of the way, I think, which is there are some narrow scope amendments to IFRS 17. You can see details in Newswire, but let's not spend time on that. Instead, I'd like to talk about the release of a new draft standard for subsidiaries who are not publicly accountable. And this is an attempt by the IASB to achieve what we achieve in the UK via the FRC with IFRS 101. And that is to say, if you are a subsidiary in a group which is publishing consolidated accounts, then it seems sensible to give you some reductions in your disclosure because equivalent disclosure is in the group, etc. And we achieve that through IFRS 101, which essentially provides IFRS users with a reduced set of disclosures. But the IASB is now trialling their own standard to achieve something similar. It is only for subsidiaries and only those which are not publicly accountable, i.e. they're not listed or they're not financial institutions. And that's slightly different to the way IFRS 101 works, and the disclosure exemptions will be slightly different. So I guess the question is, will that be adopted for use in the UK by the new UK Endorsement Board? If so, does that spell the end of IFRS 101, which is a problematic standard because it is UK GAAP and therefore company law applies when you adopt it. This would be a more native IFRS solution. So it doesn't quite achieve the same thing, but it's close enough to make that an interesting area to watch. So again, details in Newswire. Go and have a look at the exposure draft and what difference that might make to those of you who prepare IFRS accounts. Otherwise, we're going to talk about a couple of FRC documents and press releases. The first one is the FRC's annual report and accounts is out. I don't know if you study the FRC's annual report and accounts as a milestone every year, but it's there to have a look at, and it further echoes their transformation from the existing regulator, the one criticised so much by Sir John Kingman in his review, into a prototype of the new regulator, ARGA, and they are increasing in size quite dramatically, strengthening their enforcement arm in particular. So yeah, you can read not just in the financial statements themselves, but in all of the surrounding parts of the annual report, a bit more about the progress they've made and where they see themselves in the future. It's also that time of year when the FRC issues its monitoring results for the biggest firms that it supervises, and we've got those reports out again. And disappointing lack of massive progress, although some of the challenger firms, such as Grant Thornton, have shown some significant improvements here and there on audits. Overall, I think the improvement is marginal for firms, but it's in the right direction. KPMG, however, highlighted for further criticism, in particular this time for their banking audits. So still a huge way to go for KPMG and some of the other big firms in terms of restoring audit confidence in the UK. So those are individual reports per firm. If you've got a particular interest in a firm, in fact, if you work for one of those firms, you'll no doubt have downloaded your own version and read it through with interest. But for the rest of us, you can get those, as with all these things, with a link from Newswire. And there we go. I said it was short this month, and it is. We are about to get back into that kind of back to school feel in September. So we'll be back in a month's time, ready with some new things to talk about. I'm sure we'll have quite a bit to talk about by then. So look after yourselves, and we'll see you in a month's time. Thanks.